If a company with top-tier margins and a rock-solid balance sheet sees its stock drop, should you run or dig deeper? That's exactly the kind of question we explore at Insightful Value, where we break down undervalued companies with real potential. Today, we're talking about Old Dominion Freight Line and why its recent stock dip might not be what it seems. This review is for informational and educational purposes only, not financial advice. Make sure to like this video and subscribe to the channel so you don't miss our next breakdown. Old Dominion Freight Line is a powerhouse in the less-than-truckload freight industry. They move goods for thousands of customers across the United States, offering high-efficiency shipping with an emphasis on premium service. They're not just another trucking company. They're one of the most profitable, best-run logistics firms in North America. With a tightly integrated network, strong service reliability, and heavy investment in infrastructure and technology, Old Dominion has carved out a dominant position in the freight world. Now let's talk numbers. The company pulled in over $6 billion United States dollars in revenue last year and maintains operating margins consistently above 20%, which is unheard of in the freight industry. Return on invested capital is exceptional. The balance sheet carries little to no long-term debt, and management has been aggressively buying back shares while steadily raising dividends. So, why is the stock down? The freight market is under pressure. Demand has softened due to post-pandemic normalization and weaker industrial activity, which means lower volumes and more pricing competition. Investors have been trimming positions in transport stocks broadly, and even the best players like Old Dominion aren't immune to short-term sentiment shifts. But here's where it gets interesting. Old Dominion has one of the most flexible cost structures in the business. They've already adjusted capacity, optimized routes, and preserved pricing discipline. Unlike competitors that chase volume at any cost, Old Dominion maintains premium pricing and focuses on high-service customers. Their recent earnings still reflect strong profitability, and free cash flow remains positive. Dividends. The company has increased its dividend every year since initiating it in 2017. The yield is modest, around 0.5%, but that's because they reinvest heavily in growth and infrastructure while also returning capital through buybacks. It's a long-term compounding story more than a yield play. Now, should someone consider investing? If you believe that the freight cycle will recover over the next 12 to 24 months, and you're looking for a best-in-class operator with a proven track record, Old Dominion starts to look interesting at a discount. The valuation is still not cheap in absolute terms, but compared to its historical premium, the current pullback could be seen as an opportunity. On the flip side, if freight volumes continue to stagnate, there could be more downside in the near term. At Insightful Value, we help you unpack these kinds of value stories with clarity and focus. We take complex financials and market data and translate them into simple, practical insights. Whether you're managing your own portfolio or just exploring opportunities, we're here to make research easier and smarter. You can find more in-depth research on Old Dominion Freight Line and many other undervalued companies at insightfulvalue.com. Hit that like button, subscribe to the channel, and stay tuned for more breakdowns that go beyond the surface.